Are you wired to be an investor? Are you wired to do it yourself? According to the largest purveyor of financial pornography, CNBC, in order to be a successful investor, you need the following traits. Time. This is not a one and done deal. Things change. You need to devote time up front and to monitor it. 2, discipline. You need to be very logical and follow rules, not emotional and react adversely in the short term. 3, confidence. You need to feel sure your strategy will work over your investment time horizon, not over some shorter term period. 4, risk management. You need to understand how you will react when things go south and to position your portfolio accordingly. 5, experience. You need training. There's no substitute for doing something for a long time. 6, staying current. You need to understand the investment opportunity set, which changes over time. Now, for instance, some of the things that appear most risky might in fact be the lowest risk investments over a long time horizon, and some things which appear to be safe might be the highest risk. 7, sweating details. You need the ability to understand that value is added in the granular, not in the general. You need to understand the vested interests of the financial conglomerates and other salesmen to manipulate you into certain behavior that is profitable for them. So let's play a game designed by a Nobel Prize winning economist that will help us figure out whether you're wired to be an investor or not. I've been using this game with clients for 15 years. The game takes place over 2 days, but in fact, it is a game that happens nearly every day. On the first day, I come to your house with a gun and tell you, you must give me money. Your choice is to just give me $3,000 or to play the game. If you play the game, you have an 80% chance of losing $4,000 and a 20% chance of losing nothing. Take a minute to think about this and write down your choice. On the second day, I'll send my beautiful young assistant because you don't want to see me again. This time she brings flowers and tells you that she would like to give you money. She gives you a choice. She can give you $3,000 straight up, or you can play the game. If you play the game, there's an 80% chance that you will win $4,000 and a 20% chance you won't win anything. Again, take a minute to think about this and write down your answer. Now, odds are you got this wrong. 92% of people in the study chose choice B, and only 20% chose choice D. This is because human beings take more risk to avoid a loss than they would to make a gain. This is called loss avoidance, a behavioral phenomenon. Let's go through it quickly. On day 1, we offered to either take $3,000 from you or take $3,200 from you. Choice B was minus 4,000 times 0.8 is minus 3,200. So clearly here, A is the better choice. On the second day, we offered to either give you $3,000 or give you $3,200, which is 4,000 times 0.8. Now, if you think of this in expected values, you make the right choice, but people don't. We're not walking calculators, and we're unable to do this. The point is that rational investors, knowing that this outcome happens all the time, would have definitely taken the expected value choice. But we think with our crocodile brains, few of us make the rational choice. There are other patterns of investor irrationality. There are all these complex financial decisions faced by investors every day, but our perceptions are based on emotions. So we face overconfidence, which is rating ourselves as above average when it comes to selecting investments. We can't all be above average. Hindsight bias. We believe that unpredictable past events, in retrospect, were obvious and predictable. Short-term focus. We inappropriately focus on the short term versus the long term. Regret. We have illogical feelings of guilt because of a poor outcome. Mental accounting. We mentally compartmentalize investments while ignoring the aggregate portfolio, and the hot hand fallacy. We perceive trends where none exist and constantly take action on this faulty observation. In fact, broker-dealers are selling this to investors like the hottest inventions in sliced bread. But let's look at how this is manifested in the real world. In the real world, investors do not get the return the investments they seek. The way they do this, we look at the return of investors based on when they made the purchase and sold them instead of what the market or the funds made. This is a more accurate assessment that looks at the cash flows. Over the last 20 years, instead of making 10%, the average investor in the S&P made about 5%. 2.7 was inflation. In bonds, the average investor made less than 1%, and the average allocation fund investor made 2.5%. In fact, if we look at the return that investors made in the largest fund available today, which is the Vanguard S&P 500 Index investor class, the return was 3.2% for the last 15 years, substantially below the 5.2 for the last 10 years that investors made. And this, my friends, might be the better metric for what investors in the stock market have been making over the last several years. If we look at the data a little deeper, now let's look at this data a little deeper. We find the worst months of investor underperformance generally took place when the market had big moves. You may remember what the market was like during the financial crisis. In October of 2008, the market was down 16.8%, but investors did even worse. They bailed at exactly the wrong time and lost 24%. Similarly, during other periods of big down moves, investors did worse than the market did for the month because they timed it exactly wrongly. We can see this happen in 1987 and in 2000. There are many other cases too. So anyway, at Global View, we think that you need to get to a worry-free state in a high worry world. We know we can't give you everything right, but we can run away from conflicts of interest. We can invest according to the opportunity set based on fundamentals, not based on trends or fads. We can coach you to understand the risk that you're taking and help you to live with that risk so that you can gain the rewards of taking that risk. And we can help you to make the right life choices, like deciding when to retire. We believe you deserve to be worry-free. Please contact us to learn more about how we approach worry-free portfolio management. Thank you.